VentureLabs. Thank you very much for joining us today. I'd just like to make a couple of introductory announcements before Chris gets going. We're very pleased to have Chris do the Pro Forma Financials. So that's what we're doing today. It's part A of a two-part series. Part B will be 1 week from right now, 10 a.m. on Tuesday, July 28th. Really looking forward to seeing more content from Chris, and also if there are companies that are on the call today which should be prepared to be an example for next week's session, we will do some work with specific companies to go through some of their pro formas and financials. Another event we have next week is Thursday, July 30th, and it's pitch decks for raising capital from different sources by Garibaldi Capital. There's a link to that one because it's different than Part A, Part B of pro formas. Opportunity for everybody to participate in that. And when they say different sources of capital, they're talking about angel, venture capital, corporate, all sorts of different classes of capital access, and explaining why their needs are different. So therefore, how you approach them and how you present to them should be different as well. I'd like to make one more slide here, if we can go to the next one. I think many of you have been participating in some of the VentureLabs webinars over the last couple of months. We're very pleased to say that we're going to expand them and do a number of other different programming pieces. VentureLabs has a community membership available for growth companies. It's not really aimed at startups, but it is growth companies. The idea behind a lot of it is a company is participating. In these days, a lot of stuff is virtual, but someone who participates as a company is assigned a lead mentor, and they'll probably have 1 to 2 hours per week of mentoring. There are additional team mentors who are available when special skills are needed. And today we'll see what Chris is doing in the pro forma area. Very clearly, he's someone who's got a lot of expertise in that space. So this is a very good example of some of the skills that our mentoring team can provide. For early stage companies, we will do market validation training. That will start in the fall, in early October, right after New Ventures BC is completed. So if that's something that's of interest, market validation training is there. That is open to everybody. You don't have to be a member. But we also have a whole series of webinars and workshops. We plan on having at least one, sometimes two per week throughout the rest of the summer, and we'll really ramp things up in the fall. And here's a link where you can see where things are on our website. There are a whole series of events. There are the ones we do. There are also very good events by third-party partners, and we're very pleased to have a number of partners that we work with throughout the BC Tech community. I think that's everything from my side. Chris, are you ready to go?
Sure. I know, Dave, you wanted to jump in with one quick poll. We've actually got 2 polls today over the course of the presentation, and this is our first one, Dave, if we want to launch it.
Actually, I'll get Pauline to launch the poll for us if she could. Right now, I don't see that capability in my command. There we are. So I'd ask everybody to tell us, are you a startup company, a growth company, or are you maybe an advisor or an EIR? Maybe you come from an accelerator, New Ventures BC, or something else. So in any case, Chris, I'm going to turn the microphone over to you and disappear. So there you go. You might want to turn your volume up just a tiny bit.
Just a bit if I can. Okay, let's see. I'll try to project a little bit louder. But Dave, look, thanks again for the intro. And once again, thanks for all of you attending. We've got a really good group of people here. And I've noticed it's a mix. Certainly the heavier percentage looks to be in the startup phase, although it's great to hear we've got a couple of growth companies in the room as well. So that's absolutely fantastic. And some of you I certainly know from past presentations. And pounding the pavements out here in Vancouver. But to give you a bit of a background on who I am, again, my name is Chris Stairs. I wear quite a few different hats in town, but I serve as an entrepreneur in residence at VentureLabs. I kind of jokingly call myself a finance guy who comes by way of sales and marketing. I actually, the first 15 years of my career, I was in sports and entertainment and worked with some of the bigger brands, the NBA, FIFA, and 2010 Olympics. But about 10 years ago, I was invited to be part of a ticketing technology startup. And it was at that time that I was introduced to the whole world of startup and everything that means. And I happened to be the spreadsheet guy on the team, which meant it fell to me to try to figure out how to express the money model for that particular startup in the form of a pro forma. Now, I'm sad to say the startup didn't quite get off the ground the way we had hoped, but by the end of it all, we had successfully raised close to $2 million in the local market through family, friends, and angel. And in part, that was accomplished because of the fact that we had a fairly comprehensive pro forma and money model. Since then, for the last 10 years, I've been advising other startups through various different brands, VentureLabs, Canada Startup Volition, to really help them understand what it takes to get your mind wrapped around your money model and to really emphasize the importance of doing all this with the pro forma. And the critical message I'm going to share with all of you is you've got to focus on your numbers and fast, because your success is all about how quickly you can generate customers and how well you can manage your cash. Now, the question is, what's the fundamental tool that you use to do that? Well, it's this thing we call the pro forma. But why and when do we start building this thing? Well, the common conversation I run into with a lot of my clients is that typically entrepreneurs don't really give this a lot of importance until they're starting to raise money. And I quite often run into people who say, Chris, look, I need a bit of a hand on my money model and my pro forma. You know, I'm about 3 weeks away from talking to my first investor. And look, that's absolutely fantastic if you got an investor on the line. But really, the reality is the pro forma is much more than just raising money. And it is a tool that you should begin to develop right from the start. And what we're going to do today is we're going to talk a little bit about what the pro forma is, not so much how to build it. We're going to have a workshop on that later in the fall, but fundamentally what you use it for, and how you break one of these things down. And where it fits in your whole journey as an entrepreneur. Dave has made reference before to the importance of, you know, that moment that you have an idea or an innovation. You need to get out into the market and you got to validate it right away. And as Dave mentioned, you know, multiple accelerators in town, certainly VentureLabs has a market validation training program in which we say, when you have that eureka moment and you're starting to define your problem product thesis, you know, you got to get out into the real world and talk to some would-be customers. You got to begin to understand what a basic prototype might look like. But what a lot of entrepreneurs neglect to do is begin to conduct financial viability at exactly the same time. Because the moment that you have an idea about, about an innovation or a product that may solve a problem in the market, you should be flipping gears and saying, okay, well, how do I think I'm going to price this thing? Are there other similar businesses that have a pricing model that I can begin to maybe consider and copy? What are the cost implications of delivering this entire solution? And then from there, what could be my profit potential? This is something that truly effective entrepreneurs are managing at exactly the same time. They're done in tandem, and it's a back and forth process because typically one exercise begins to inform the other and so forth and so on. So again, I encourage entrepreneurs to begin that process right at the start. Now, there's a caveat here. You don't necessarily need to jump into this comprehensive spreadsheet straight out of the gate. Some of the most effective entrepreneurs I've ever met or worked with usually scratch things out in the rough with just pen and paper. I call it your cocktail napkin numbers. You know, it doesn't take long with a little bit of research and a little bit of an investigation in your market, talking to some would-be customers, talking to some would-be suppliers to start to get a sense of what your cost structure might be and whether there could really be demand and how you may price things. But if you continue this exercise and you determine that, you know, on paper, the numbers are compelling, then absolutely you need to transition and begin to build a comprehensive pro forma with the spreadsheet, multi-tab pro forma. So then the next question is, well, what is that pro forma really? What's it doing for me? Roughly speaking, how is it structured? So in short, and I'm drawing upon similar information that Mike Volker shared with us about 2 weeks ago, and I'm hoping many of you have took the time to watch his video, which is also posted on VentureLabs. And if you haven't, it's certainly something you want to go back to. But Mike Volker typically talks about the fact that the pro forma is a forward-looking projection, commonly it's a 5-year cash budget. Now, in some cases, you know, your business might be much simpler. You could be opening up a cafe, in which case, to be honest with you, you're probably going to get a pretty good sense of your money model, even just after modeling out 3 years. On the other hand, if you're manufacturing a pharmaceutical product, then you could be forecasting even further out, 10 plus years. But whatever it is, the point is it's a forward-looking cash budget, and it's essentially meant to illustrate three things for you and help you evaluate three things. And I'm going to get into each one of these in a little bit of detail, but quickly, the first thing that the pro forma is going to require you to do is to numerically describe all the moving parts of your business model. The next thing the pro forma is going to do is it's going to begin to illustrate what your growth story looks like over time. Because remember, again, this is a 5-year cash budget projection. So you need to start thinking about, well, what's my sales trajectory going to look like? And how am I going to accomplish that sales trajectory? In turn, what sort of economies of scale might arise over time as I get into volume? All that's going to lead to a discussion about profit potential and cash requirements. Now, the third reason why you're developing this pro forma long before you're thinking about talking to investors is because you're then running sensitivity analysis. Once this tool is built, you can start to run various what-if scenarios to help you really understand your viability under different business circumstances, and ultimately determine whether you are actually looking at a profitable venture or not. So now I'm going to talk a little bit more about each of these in particular, starting with your business model. And look, this may seem self-evident, but again, I've found in my own personal experience assisting entrepreneurs that this, because of its simplicity on paper, it's often overlooked. The first thing a pro forma requires you to do is to begin to attach numbers to each of the core functions of your business. And I always say, look, keep it simple. I've modeled everything from device to software as a service to an e-commerce retail plan. I'm going to tell you that almost every business model boils down to three core functions. Sales, which is all of the sales, marketing, and media relation activities you've got to undertake in order to acquire customers. Ops, which is the back-end engine that you need to build in order to have the capacity to serve those customers. And finance, which is essentially about understanding your cash and cash flow to keep the whole engine running. Now, that may seem pretty straightforward, but the reality is you've got to very early on step back and really think through what that means for your particular business. Because as you can see here, even at a 10,000-foot level, what you're going to be describing in your pro forma for a physical product is going to look very different from something like a self-service SaaS. With a physical product, I mean, straight out of the gate at the operational level, you're going to have to start figuring out the logistics and storage implications of ordering raw materials in growing volume. You've got a manufacturing cycle you've got to figure out, and there's cost implications related to that. Then once the units are produced, you've got an inventory story you need to oversee. That's going to lead to warehousing. And then on the sales and distribution side, you have a whole series of logistics you've got to sort out to get a product, say, from an overseas factory in China or Taiwan into North America. Now, very quickly, you switch gears, you look at a self-serve SaaS, I mean, very different. And in some cases, quite a bit simpler, which is why a lot of investors right now are kind of excited about SaaS, because really, development costs up front, relatively low compared to a tech device play. It's a cloud-based operation, and your sales model is completely different. If it's a self-serve SaaS like HubSpot, at this point, it's almost 100% about digital sale and distribution. So I'm just using these as two examples, and these are two of the case models we're going to run through today, but you can start to think about the fact that each one of those is very different as it relates to sales, ops, finance. Now, the one bit of bad news that I'm going to share with you today is that because business models can be very different from one type of innovation to the next, there is unfortunately no universal pro forma template that's out there. I've tried time and time again to try to Google some sort of a magical template, and there's a lot of similarities without a doubt, but the reality is you kind of need to dive into the weeds with your own business to be mindful of how you may need to modify your pro forma for your own purposes. However, the good news is that second piece, the growth story, I'm going to tell you that I don't care what business you're in, the basic outline and milestones of a successful growth story is absolutely universal in design. And it's a 6-part story that serves as the framework for whenever I'm conducting analysis on the viability of a company. It's the storyline that you're typically going to use for a pitch. But again, even before you're thinking about raising money, It's the set of milestones that you need to understand in order to determine whether or not you actually have a viable opportunity in front of you. Here's the 6 parts. Very quickly, I'm going to run through them, but then I'm going to illustrate through some case models how you would apply them. Step 1. Do you clearly present in your pro forma what early stage investors call your unit economics? Do you precisely understand with a single transaction and the lifetime value of a customer, how much gross profit you can make off a single transaction? Because that's the essential building block for the rest of your pro forma. That needs to be illustrated in your pro forma. Step 2. The next question I'm going to ask myself as a strategist and analyst is to say, okay, that's great. You know how to make money off a single sale, but is this a repeatable opportunity over time? And there's actually 2 dimensions to that. First off, have you identified the markets in which this sale can happen in volume? Hopefully there's more than one market you could potentially target. And if that's the case, do you know which one's your beachhead? But secondly, repeatability, or a bit of a twist, recurring revenue is also about the fact, well, how many times could you actually sell this to the same single customer? Because that also has an implication on your revenue potential. The third point to the storyline, critical one that Mike Volker brought up 2 weeks ago, cash flow positive. Most of you are early stage startup, and I'm going to tell you, when you're designing your pro forma, one of the first things you're going to need to figure out is, when do I break even from a profitability standpoint, and when do I achieve cash flow positive cash generation? Secondly, can I actually do that in my beachhead market? And hopefully the answer is yes, because if you determine you can't even get cash flow positive without penetrating a second market, that's going to introduce quite a bit of risk and complexity. Fourth part of your story, and again, all 4 of these ultimately revolve around that sales function we talked about. Okay, great. You know what cash flow positive looks like. You feel comfortable that you can achieve that relatively easily as a milestone in your beachhead market. But then what are the scaling mechanisms? What are the growth multipliers that enable you to achieve significant return in your 4th, 5th, and 6th year? And these get into discussions about, are you pursuing channel partnerships? Are you patent protected? Do you have market exclusivity? Can you increase the lifetime value of a client over time? These are just some of the examples of what your growth mechanisms may look like. 5th of the 6 parts are capacity constraints. We're going to switch gears, and your pro forma is also going to start to illustrate for you, as you grow in volume and revenue over time. Well, wait a minute, what's that doing to my capacity? And what do I need to do to start introducing economies of scale, growing out my team, maybe expanding my facility, or approaching a larger factory if I'm starting to manufacture in volume? And last but not least, a properly constructed pro forma is also going to start to tell you your cash flow story over time, and ultimately your cash funding requirements. That is the core story that you need to understand in terms of the evolution of your growth as a company. It is the essential story that is part of your pitch presentation to investors, and certainly it is the step-by-step analysis that's used during due diligence. The good news is all 6 parts of those can be illustrated with numbers, and all those numbers are drawn from your pro forma. So if you come to understand really what the end game is as a story, it starts to make a little bit more sense why you're building out a pro forma. Now, here's the last, third most important part of why you're developing a pro forma. Once it's built, you can use it for essential, what we call sensitivity analysis, which is running different what-if scenarios to understand what your risk might look like under different business circumstances. And I like to use the wise words of our main man, Commander Chris Hadfield. If you haven't read his book, it's actually a great book for entrepreneurs to read. And in chapter 6, he talks about surviving in outer space is often asking you, what's the next thing that could kill me, all the time? And he speaks to the fact that you need to be in an active state of thinking, managing, and mitigating all the time. Well, the reality is the pro forma is precisely the tool that helps you to numerically start to identify where there could be risk and what you can do to address it. And you'll use it to start asking yourself questions like, okay, well, I have a rough idea of what I think cash flow positive would look like, but what does happen when my sales suddenly double? Do I have the capacity to handle that? When do I need to switch gears on the operating model? What happens if the cost of lithium, which turns out to be a critical component of my device, what happens if that suddenly moves? What does that do to my gross profit? Or the big one we're all struggling with right now, what happens when COVID-19 shows up? I've got to completely reset my revenue generating assumptions. The list goes on. What you want to do once you've built the pro forma is start running through a whole list of questions and then adjusting your numbers to see what happens and to determine ultimately two things. What are your growth levers over time? And also, where do you encounter financial vulnerability? And often that vulnerability is around either sales projections and or cash generation. The sooner you start running those scenarios, the sooner you can start considering strategies to mitigate those risks well in advance of actually getting into trouble, which is exactly what Chris Hadfield talks about when he's floating around in outer space. The further ahead you think about crisis, the more likely it is that you can resolve it before it even happens. So it's an essential, powerful tool of analysis. I'm going to be switching gears shortly. I'm going to get into some examples, but I'm going to step back for a second. I'm going to say this is why you are building a pro forma. The goal is for each of you as entrepreneurs to get nimble with your numbers. And you are doing this first and foremost for your own sake as a founder and strategist before you're even considering using the tool for due diligence when you're pitching investors. That's the big picture. That's the why we're focusing and spending so much time and attention on the pro forma as a tool. Now, before I switch gears, we've got a bit of a poll we're going to run, but what I am going to tell you today is the rest of this session is going to be me kind of showing you precisely what I mean by all this, working with two case studies today. One is hardware and device. The other is a self-serve SaaS hypothetical model. And then next week, we're going to spend a little bit of the beginning looking at B2C e-commerce. I am going to say that, look, I know a lot of you on the line may not even fall within any of these three business model categories, but don't worry. It's really the exercise of me running through a pro forma. I'm hoping it's going to start triggering in you kind of an understanding of how this may apply to your own business model. Dave, I'm going to take a break for a sec. I think it's time for the second poll before I open up my first spreadsheet. How are we doing so far? Thanks, Pauline. Okay, so we do have a few folks with device out there and some SaaS. Okay, great to hear. So these case models are going to be relevant for at least some of you. And B2C e-commerce, like I said, we'll get into next week. Service providers, the good news for you, and I mean, that could mean any number of things. The model tends to be a little bit simpler when you're modeling out service provision. Having said that, there's still caveats. But look, gang, this is really helpful. I'll let that keep running for a few more minutes. What I'm going to do, though, is I'm going to switch files now. So I'm going to pull out of this. Our first case study is going to be hardware and device. I'm going to stop sharing this one. And we're going to switch over. There it is. Okay. Okay. Dave, let me know if you can see this. We should have a
Yes, we can. We're all set.
Fantastic. Thanks, Dave. Okay. What I'm going to do for you today is I'm basically going to take you for a spin in my car. Okay. And what we're going to do is we're actually going to look at a particular case model and we're going to walk through, roughly speaking, those six parts to that growth storyline. I'm going to pretend I'm an analyst and somebody has just sent me a pro forma. And I'm going to start quickly breaking down where I think there's viability and where I think there's risk. And again, you can peel away more and more layers. I'm just going to kind of do a first blush at the 10,000 foot level. Here's the case model. I'm going to pretend that somebody has approached me with a brand new piece of HVAC technology that you're selling into corporate towers and high-rise residential buildings. This HVAC unit, I'm going to say, retails at $2,500. And I'm going to say, on average, in order to upgrade, you need to get roughly 2 units in per floor. I'm totally making this up, by the way. But as a result of the introduction of this, you're going to be saving an incredible amount of money over time on power bill and all sorts of other efficiencies. Okay, that's the backstory. I'm now going to be looking at this, and I'm going to do a first quick blush at what's typically your 3-year summary. And I'm going to say, okay, interesting. You're telling me that you're going to start out easy into the market selling 180 units, but by the 3rd year, you're going to be upwards of 3,500 units. Very quickly, I'm going to think to myself, look, it's highly unlikely that this can be done alone by a startup. I'm hoping to see that there's some channel partnership strategy involved. And certainly that is reflected in line number 10. Yep, there's a line item for channel sales, but I'm going to want to investigate that a little bit further. Next thing I'm going to drop down to is gross margin. For every single unit that's sold, how much money are you retaining after direct costs that you can put towards your bottom line and cover your fixed costs? Well, I'm seeing an interesting and a promising story here as it relates to your gross margin, which makes sense as you sell into more and more volume. I'm seeing that margin increase by 30 to 40 to 50%. But I'm still going to want to know the backstory on how that's happening. I really want to understand the unit economics. Now I'm going to scroll down. I'm going to see a whole list of fixed costs. But then I'm going to get to the bottom and I'm going to say, okay, my fixed operating costs I can see are increasing from about 1.3 million upwards of 2.1 million by the 3rd year. So that's a pretty big nut. I've got to make sure that I continue to cover over time. But the good news is you're telling me that by your 3rd year, you're going to be recording a profit and you're going to be walking away with about 1.6 million in net earnings after costs. Interesting story. But next step, I mentioned to you the importance of unit economics. This is a pivotal tab, and I don't care what business you're in, you as an entrepreneur need to precisely understand how you make profit off a single transaction. And I'm going to tell you, in the case of this pro forma and the next one I sell, every other tab is fed by the results of this tab. We're going to walk through the scenario and we're going to say, look, let's pretend that you fundamentally have 2 ways of selling this technology into the market: direct sales by your own sales team and channel partner sales. There's a lot of things you need to evaluate as it relates to unit economics. You've set a price at $2,500, but you need to be mindful of the fact that you've got 7 different material components that you are managing in order to manufacture this unit. Plus, you've got an assembly cost. And then you've got per unit freight to get that thing back overseas from China to North America, duties and tariff. There's going to be a per unit warehousing cost, handling and shipping, and there's going to be internal commission per unit sold that goes to your sales team. And I'm setting that further down line 35 at 10%. Okay, that begins to paint a bit of a picture. This is now telling me that in early days, my total direct costs run from $1,900 per unit down to $1,100 over time. Well, why is that happening? My gross margin is actually increasing from 23% to 55%. Well, no big surprise. I've done some research and I've determined that based on purchasing material in more and more volume and manufacturing in more and more volume with my factory, I'm going to see that the average cost per unit declines over time. And that's why we're introducing further gross margin. Okay. That's a good story. But now I want to get into risk analysis. I want to ask myself, wait a minute, what happens, for example, if one of the material costs change? This all is something that you ideally have built in your pro forma because you need to be mindful of your risks here. And this is something ultimately that an investor is going to investigate at later stage due diligence. I'm going to show you something. We're going to go back to your 3-year pro forma. We're going to look at your gross profit in the 3rd year. And we're going to see a number that sits at 3.8 million. Okay, now your materials engineer may come to you and say, Chris, look, I'm sorry, but I found out that there's a real shortage in component number 1 worldwide, and we're going to be suffering a potential doubling of the cost of that unit. Well, that unit right now is averaging $30. If that material component doubles, it goes to $60. Now, I want you to watch your gross margin at the bottom. That 55% now drops to 54%. That's really ultimately not too much of a concern. If that is a component that is subject to fluctuation in the market, am I overly concerned? Let me go back to my pro forma. My gross profit has dropped from 3.8 to 3.7 million. It's a projection. It's not an absolutely written in the stone number, but I'm seeing, over total revenue of 7.6 million. That doesn't represent a huge amount of swing or risk. But let me run a scenario where in actual fact, it's component number 7 that is subject to wild fluctuations in material cost. Let's say that doubles. Well, now our gross margin has dropped to 47%, and we look ahead at what that could do to our gross profit. Our gross profit has now dropped from 3.8 to $3.1 million. That's a swing of $700,000 in a single year. That's going to cause me a little bit of concern. I've already, again, this is long before you've spoken to an investor, you started to build out a model that's helping you understand where you have risk in your material components. And by that discovery, you may go back to your material engineer and say, hey, we need to look at a second and third alternative for material component number 7. Is there anything else that we can use to try to mitigate that risk? That's item number 1. Second item, as it relates to these gross margins, and I'll move on to our next tab. At some point, you're going to need to start using channel partners to push this product into the market. Well, a question you need to ask yourself, those channel partners are going to want to get a discount on product and volume or some equivalent sales commission. Question you need to ask yourself is, well, what can I afford? Well, the fact of the matter is I've seen different models where that commission ranges between 15 and 30%. I've plugged in 20% right now, which shows you, if you look at line 32 at the bottom of the yellow box, that you know what, in low volume, by the time, I get money in the bank, I'm barely making margin on this, but that channel partner could potentially be driving units much more quickly into certain markets that I'm going to be able to. And if we start getting into volume, now I'm back up to a bit of a healthier margin. When I look at the bigger picture, that may make sense for me. But what if I start negotiating with a particular channel partner who's really aggressive and says, no, I won't do this for you unless you give me 25%. Well, now you've got a tool to tell you right away, that doesn't look so healthy for me. What can I do here? Maybe I can say, look, you've got to guarantee a minimum of 100 unit sales before I'm going to give you that kind of a discount. Or maybe you just push back on the channel partner and say, look, I can't work according to that model. Is there any way we can negotiate this a bit differently? Now, again, I've got to switch gears because there's a lot more I'd love to show you, but this just begins to give you an idea. And a lot of people don't understand that this is part of your overall pro forma exercise. I typically include this as your first and foundational tab because it starts to build out the rest of your pro forma. And as I said, it enables you to begin to kind of evaluate where there's risk. Now I'm going to switch gears for a sec. I'm a sales rep. That's where I originally come from. And I'm going to look at all this and I'm going to say, okay, that kind of makes sense to me. But I'm going to do some quick cocktail napkin number math. I've done a little bit of an assessment here. And I'm going to say, wait a minute, how many of these units do I actually need to sell to break even? And what does that look like relative to the size of the market? We keep talking about the importance of TAM, SAM, SOM. Okay, well, when does that really kick in and mean something for me?
Well, it's Dave.
Yeah.
Just if I can make a comment before you move into the sensitivity analysis. One of the things we saw in the marketplace in BC, everywhere, is a lot of medical device companies who, when COVID actually became a big factor in the marketplace, all of a sudden their cost for components went up because they needed to move sourcing from offshore to nearshore. So it's a very good example of something that says, well, maybe I'm going to make all of my components in Canada through somebody I trust. I won't have the same volume. My unit cost will be a lot higher, but I will not be able to access offshore manufacturing in a place like China for the foreseeable future, 6 months, 12 months. So it's a very good case for people recasting their financials and their projections. And I think you've given them a very good methodology for doing that if it's something that happens to a company.
Dave, fantastic point, and thanks for chiming in. I appreciate that. Feel free to do that again if you have some great ideas. And actually, funny enough, one of the clients I work with or have worked with through COVID, that exact challenge happened with them. They produced cleaning chemical company, major one in Canada. The challenge was all their plastic bottling components came from China. And that channel, that supply channel, got completely shut down. So that's exactly what they needed to do. They needed to look at alternative bottling solutions within Canada, and that drove up their per unit price. Thanks for that, Dave. everybody, again, there's so much I wish I had the chance to cover for you today. I'm going to ask you to just kind of take my word for it when I say I did a little bit of math. I kind of went back down to the bottom of, your fixed costs over time. Trust me when I say that, roughly speaking, break even occurs when you cover about $1.8 million worth of fixed costs. That's the math. And so if we go back to the top, I'm kind of estimating that means your monthly burn is about 150,000. You need to cover 1.8 million in fixed costs. I'm going to make a few other assumptions. Again, this is just an approximation. This does not need to be written in stone, but this is a way you use the pro forma to start to evaluate your viability or potential risks. And I'm going to say that between direct sales and channel sales, you're roughly selling your unit at an average of $22.50 per unit, roughly at a gross margin of 45%, which means you're roughly walking away with $1,000 in gross profit. Well, you do the math, it means you need to sell basically 1,800 units each year in order to sustain a break-even revenue level of about $4 million. Okay, well, the sales strategist in me is going to step back for a second. I'm going to say, okay, well, wait a minute. What does that even look like relative to TAM Samsung? Remember, one of the questions I asked you is, can you even do this in your beachhead market, the market you're targeting? Like, what percentage of that market does that even look like? Well, when I actually drew up this mock pro forma, I stepped out on the balcony of my apartment building and I looked around the block, and there's 7 buildings on my block that represent a total of 80 floors. And I'm telling you, you got to get 2 units in per floor. I have a potential of selling 160 units of this technology in one city block in Vancouver. Now I think about the total addressable and possibly attainable market, and I'm telling you that is a big, big green pasture. And me to put a sales engine behind this, for sure I'm going to be leaning on channel partners, but I'm going to tell you that that's a big market to shoot for. That's encouraging. What if, on the other hand, I told you this had nothing to do with HVAC technology? What if you're pitching an investor and you're saying, you know what, I'm selling this really cool, sophisticated device that, and I'm going to sell it into chemistry labs in high schools around North America. And I'm going to tell you that each high school has one chemistry lab and they're going to need one of these units. Well, I did a bit of quick math and I figured out there's about 35,000 high schools in North America between the public and private school systems. Well, now as an analyst and investor, I'm stepping back and I'm saying, wait a minute, you're telling me that you're going to sell 3,500 units by year 3. That's 10% of the total addressable market in North America. And you're saying you're getting that done in 3 years in a sector that I've sold into and I know is notoriously long in its sales cycle, like takes usually over 12 months to sell if you're lucky, and has very tight budgets. Immediately, I'm going to look at that and I'm going to say, before I need to get into the weeds, that I'm really leery about whether this is a viable sales model. So just giving you some examples here. However, it's HVAC. And you're selling into construction companies and you're selling into property managers. But now I'm going to switch to your monthly sales model. And again, we don't have time to get into sales forecasting. That really deserves its own webinar. But I am going to kind of look at some assumptions that I've made, that you've made, because you've put this in front of me and I'm your analyst. And I'm going to say, okay, so yeah, this makes sense. You're telling me by the 3rd year that at least 2/3 of the volume of what you need to sell, you're selling through channels and not directly. Ideally, I'd like to see that be even a bigger number. But okay, you're aware of the fact that in order to achieve this volume, you've got to be relying on channel partners. But this gets into my question about growth multiplier, your scaling mechanisms. On the sales side, I kind of want to know, who are those channel partners and how far are you in your dialogue? Well, look, if you come to me and you say, well, actually, Christopher, I've got signed deals now with 3 of the largest HVAC suppliers in the world, Trane, American Standard, and Lennox, and they've all committed to a minimum volume of sales by the 3rd year. Okay, now again, you've got me excited. We've gone now through first unit economics. We know this is repeatable. We haven't gotten into cash flow positive. I'll talk to that shortly. But you also now have a growth story that's compelling for me. Now, the next thing I'm going to do is switch gears, and I'm going to talk about cash flow positive in this particular case. And again, I want to remind you, sorry, I'm going to jump to your 3-year summary. you're telling me that you're making a profit by the end of the third year of about $1 million. Okay, but that's very different from understanding what your cash flow is going to look like. And in the case of device and manufacturing, cash flow gets very tricky. And again, Mike Volker made reference to this 2 weeks ago. The timing of your sales in many instances is not the same as when you receive cash. And I'm just going to quickly draw your attention to line 8, direct sales. If you recall, I'm going to say that in the first month, you sold 3 units at 2,500 in the month of January. But what I'm going to say is there's a 30-day delay before you get payment. Well, now you think about that over time. When you get into your third year, I'm making an assumption that you're actually going to see 30-day delay month after month. So by the time you get up to the end of your third year, you're generating roughly $800,000 in revenue, but there's a 30-day delay before that cash hits the bank. Okay, now, at the same time, you need to pay off suppliers and a factory overseas. And I can tell you, when you start manufacturing device in volume, it's not on demand. You're probably going to be working with a factory to manufacture in quarterly allotments, and you're going to have to project those sales over time. And you're going to need to cut a check in advance to get those units on the assembly line. Well, let's look at the COGS. Hey, $43,000 doesn't look like a lot. But if we project through to your third year, geez, by the second quarter of your third year, you're cutting a check of nearly $1.5 million in the month of October. That's a lot of cash. And at the same time, you're suffering 30-day delay on the cash coming in from sales. This immediately starts getting you again to step back. Think about Chris Hatfield. I'm looking at some numbers here that are a little bit concerning, but what can I do to mitigate that risk? Well, one of the standard practices is to get into a discussion both with your suppliers and with the factory and say, look, can we sort out a bit of a payment plan? Can I pay a bit of a deposit up front? Can I pay a bit of money on the month it's manufactured? And then maybe the difference afterwards. That could also be a discussion that you get into with your buyers. But again, you're bouncing back and forth between looking at the numbers and then stepping back and saying, ooh, strategically, how do I manage this? Now, the last thing I'm going to show you is you got to figure out big picture. Okay, you can see there's a long row of red numbers at the bottom here because, of course, you're a startup and you need a lot of cash to fuel this whole machine. Well, the way I build a pro forma, and again, this is just sort of one approximated way of doing it, but typically at the top and the bottom of your cash flow statement, you're going to have an opening balance per month and you're going to have a net closing balance per month. Well, I'm going to say that, let's pretend you already have $250,000 in the bank and you've secured that through family and friends, some of your own personal investment. Maybe you got some non-diluted funding through the government, what have you. But now you got to figure out, what am I looking for in order to really try to finance this engine? Play around with numbers. We'll put in 2 million to start. That looks okay to begin with. But as you get further along, no, you're still in the red. So let's see what this looks like. 2.5 million basically gets you there. Oh, still not quite there. But you're looking at about 2.5, 2.6 million. And again, this is a ballpark. And this is playing with all of the earlier assumptions that we played with. I think I may have, that number's down because I think, oh, that's right. The number's down, sorry, I bounced back because I mentioned to you that material component number 7, I had bumped up to 400. Let's drop it back down to the original 200 I was projecting. Then I'm going to tell you that I think you're going to be able to get by with about 2.5 million in raise. And you're in the black. But again, this isn't reality. This is a future projection. But you're in the black, and even in the lower months, your burn at this time is about 150,000. Well, you got about 45 days of cash in the bank at the worst of times. Normally you want to see that a little bit higher. But again, this tool begins to help you understand your cash levers now, okay? I wish I could spend more time to dive through some of the details, but you start to see how a well-constructed pro forma is helping you run through unit economics. Is this a repeatable opportunity? How much cash do I need? What's cash flow positive kind of look like? What's my growth mechanism? And I'm going to speak a little bit about capacity when we get into our second model. So that's it for the device. I'm going to switch gears. And just as a heads up, gang, I apologize. I'm probably going to need about an extra 5 minutes to get through all of this. Dave, while I'm switching files, anything you want to add here?
No, I think that's good. Let's just keep rolling.
Keep rolling. All right. So I'm going to share. Where are we now? Oh, sorry, wrong one. All right. Dave, you tell me if you see something that says the Super SaaS company.
Yes, you're ready to go.
Fantastic. All right, we're switching gears now, gang. And I know some of you on the line are, I self-identify more as a SaaS company. And I'm going to show you, you're going to see some similarities. We're starting out with sort of our aggregate 3-year summary pro forma. And again, that aggregate quickly is drawn from a month-by-month sales model, year 1, year 2, year 3, looking at it closely every month. And also, I'm not really going to get into the specifics of this too much, but also a thorough month-by-month breakdown of your fixed costs, your operating costs, okay? So again, that leads to a pro forma summary. So this time, I'm going to do the exact same thing. I'm going to run through an overview, and I'm going to say, okay, you're telling me that you're going to start off with total paid subscribers by the end of the first year of just over 500, and by the end of the third year, you're going to have 5,500 paid subscribers. Well, that's a pretty big number. I'm going to want to know how you get to that. I'm also learning that, wait a minute, you seem to be selling this SaaS in 3 different forms: basic, professional, and enterprise. And you're saying that by the end of the third year, you're going to get to about $3 million in sales. Another key piece, you're going to look at your gross profit. And what I'm going to say is your gross margin is 95%. Well, that's a bit of an odd one. And it gets into actually a bit of a discussion we can't really get into the details of today, but SaaS is kind of a funny one because it doesn't really have direct material costs the same way as a device. And yes, it sort of does have, direct costs of sale, customer acquisition, but it's a difficult thing to target precisely sale by sale. So instead, I'm going to show you a different way of evaluating that when we get into your unit economics. In the meantime, I'm going to say, look, roughly speaking, your direct costs for sure have to do with credit card processing, the hosting fee, and maybe some other lightweight transactional fees. I'm going to look at the bottom. I'm going to look at your total expenditures. I'm going to see a much lower, somewhat lower number, which makes sense for a SaaS. You're going to have about 800,000 in fixed costs in your first year. That's going to grow to 2 million by the end of the year. That's a fairly and surprisingly big number, but you're going to see why that happens. And you're telling me, look, your net profit's going to be about 700,000 by the end of the third year. Okay, again, let's switch gears and look at your unit economics. And for a SaaS, it's something a little bit different. And it's really about understanding what are the target economics you should be shooting for. Okay, so with all SaaS, typically you have 3 different offerings, and you've got the basic, professional, and enterprise, and that suggested retail price increases as you get into more robust functionality. But unlike direct costs of sale, what you're really trying to figure out with the SaaS is, well, what is the total target lifetime value of a customer over time? Because this is a subscription-based service. How long am I going to keep these people? How many licenses am I going to get per account? And then roughly speaking, what's the maximum acquisition I can afford to spend to get one of these customers? And I'm going to just quickly run through the numbers. A reminder that you can go back and pause this video when it gets posted. But I'm going to tell you that all the numbers that I'm going to share with you today are actually based on some research that I've done on the top 50 SaaS companies in North America and what they discovered were the winning metrics. So this is 50% forecasting, but to be frank, this is really 50%. You got to hit these targets in the long run in order to be successful. And what I'm going to tell you is, in the case of a basic unit sale, we're going to estimate the average customer lifetime is about 11 months. It's going to be a single license that you sell that's paid for with a credit card month over month. When we get into professional, we're going to say, look, the switching cost for a company gets a little bit more expensive. Once you've invested in a software, you're not necessarily as prone to jump ship as quick. And you may have more than one user involved. So for a professional, we're going to conservatively say the lifetime of a customer is closer to 15 months, and you're selling 2 user licenses per month. With enterprise, super conservative, we're going to say 18 months, and on average, you've actually got 5 users accounted for within the account. As a result, you add up the math, you got lifetime value of 500, 2,100, close to 10,000 for enterprise. Now we've got to figure out, well, okay, but how much am I spending to get that money? And the way SaaS works is you basically need to figure out what is the total target customer acquisition cost that I can afford to spend to land these customers. And that target of 33% is actually a bit of an industry standard. Once you kind of introduce efficiencies over time with your digital marketing engine and your servicing engine, you're basically saying to yourself, I'm spending about 20% on digital marketing, promotions, and service support. You're going to be spending probably about 10% of some kind on internal commission or quota bonuses for your sales and marketing team. And then there's that, maybe 5% on processing and hosting fees. That adds up to about 33%. That means your total direct costs of sale are about 184 to 3180, which leaves you with a net lifetime value of between 340 up to close to 6,000, which is a gross margin over time for the time and the life of that customer of about 65%. And the reality is that is a standard gross target for SaaS. And to be frank, it's a standard gross margin target for most technology. I'm usually looking for somewhere between 50 and 75% to have a degree of comfort. That's before you introduce channel partners, to have a degree of comfort that your economics are sound. Last thing I'm going to say is with SaaS, you then need to figure out, okay, well, what's my payback period? And again, some fairly straightforward math. In the case of a basic sale, if you know on average you're targeting for about $180 in direct sale, and you know you're getting $50 out of a customer every month, that means you need to hold on to that customer for a minimum of 4 months out of the average lifetime value of 11 months before you're actually making a profit on that particular customer. So another way of looking at that is that line number 13, if your average lifetime starts to drop from 11 to 10 to 9 and 8 months, but your payback period is fixed at 4, that's introducing an element of risk. Now, again, we could dive into this a little bit further as it relates to unit economics for SaaS, but I'm just laid down. What I'm going to do now is I'm going to switch gears and I'm going to get into your sales model. And again, the way you evaluate your sales model is different from device. Devices, we saw, in most cases is heavily dependent on channel partner strategies. In the case of SaaS, it's usually about setting up a digital marketing engine. And that digital marketing engine is about understanding the digital pipeline and the target conversion metrics you need to achieve in order to be successful. And again, all of these percentages are roughly based on actual industry averages of the more successful SaaS out there. And some assumptions you may be able to make, and you can adjust these. Again, a pro forma is an adjustable tool, but you're looking at, let's say, traffic to the website converted to a 30-day free trial, you're targeting for 5%. Then at the end of that trial, you're converting, hopefully you're targeting for about 20% of those individuals are converting across these 3 product categories. And that 20% is considered a target you should be shooting for, industry standard. We know the different user counts, but you also need to bear in mind that there's churn. For those of you involved in SaaS, we're all familiar with the notion of the churn. In the case of a basic sale, you're losing close to 5% of your customers every single month, which means in theory, after 20 months, you've lost that batch of 100 customers. Trust me when I say, when you start looking at each of these cells, we've got formulas that draw upon each of those assumptions that build towards a scalable model over time. And what you're basically going to learn and what you need to evaluate is whether it's realistic by the 3rd year based on your digital marketing budget and based on what digital marketing experts are telling you about building traffic. Can you hit 5,500 cumulative users over time? Does that look like a reasonable breakup between basic, professional, and enterprise? And I'm going to tell you basically what it works out from a traffic perspective is that you're targeting and need to spend money talking to digital marketing professionals. You need to tell that marketing professional, I've got to have close to 400,000 eyeballs, unique visitors to my website by the end of the third year. And I'm going to tell you that's somewhat of a real number, because when you go back to the research I did on the top 50 SaaS, they said the lower 40% of those top 50 SaaS were reporting that they were getting 500,000 unique visits a year in order to sustain their model. So that tells you a little bit about the sales model. Dave, I'm nearly done. We're going to switch gears. We're going to look at cash flow as it relates to SaaS. And in this case, I'm going to tell you, I ran the numbers. Again, we're going to say you already have 200,000 in the bank. I'm going to tell you that 900,000 is basically the target you're tentatively looking to raise in order to sustain the model and get to cash flow positive. But I'm also going to point out that cash flow is very different for SaaS compared to the device situation, because remember, you're charging immediately to a credit card. So basically, the month you record the sale is the month the cash comes through. And similarly, your direct costs of sale typically happen in the same month. So that's a bit of a happier story for you. And what's going to happen over time is you're going to see the number drop in 35. The number drops, it keeps dropping. That means you're still in a cash negative. We're not quite where we need to be. I think it's $1 million that gets you what you need. But then all of a sudden, about halfway through the third year, you start to see a dramatic increase in your cash. And that is the point at which you know you hit cash flow positive. Assuming all of your other assumptions are accurate, I think it's $1 million you need to raise, and assuming you feel comfortable about all your other assumptions, that is kind of the swing point for you from a cash perspective. With this particular model and these assumptions is right about March, you've got a bit of a tipping point and that number starts to rise. One last thing I'm going to show. Let's go back to your sales model. One last thing to demonstrate, the difference between profit and cash flow. Again, I reminded you that your net profit at the end of the third year is about $700,000. I want you to see why you need to run these reports, because profit is different from cash. I'm going to show you what break even looks like, and I'm going to do that. I ran the numbers before. If it turns out your traffic to trial conversion is only 3.5%, here's what that does. That actually means by the end of your third year, you're only actually generating a total cumulative number of users of about 3,900. You switch over to your 3-year pro forma, you're going to see that your net earnings are about $700, basically break even, right? So you went from 700,000 down to $700. But look what happens with your cash flow. No big surprise, your cash flow is in the red. Now, your instincts are going to tell you, geez, does that mean I need to raise $1.7 million instead of $1 million? Well, the answer is no. If you run the numbers, because your sales have gone down, there's a whole bunch of operational costs that actually also have decreased because you haven't necessarily expanded capacity to handle 5,500 customers, which means in actual fact, in this scenario, you only need to raise 1.4 million, not 1.7 million, in order to sustain that model and in order to try to get you to a profitable position under those assumptions. Now, look, there's a whole bunch of assumptions again you could drill holes into. All I'm trying to do is put you in the car and drive you around the block a couple of times so that you can see, once it's built, how you actually use this tool to conduct different types of what-if scenarios and really get comfortable with understanding those growth levers and where you may have certain financial vulnerability. Dave, that's it in a nutshell. And I know we're going to be meeting again next week. I'm going to switch back to the PowerPoint presentation. I know we're going to be meeting again next week. So we'll have a chance to maybe visit some questions. We're going to be running through another scenario.
Thank you very much, Chris.
Yeah, is there anything else you'd like me to add or you'd like that?
I'll just, if I could, I'll just make a few comments in closing. First of all, I'd really like to thank Chris for giving us a great presentation, walking us through the basis of how you do a pro forma, plus a couple of great examples. We will lead off the session next week on the 28th with an example, which is a B2Commerce internet play. Chris will walk you through a third one that we didn't have enough time to do today. We'll also start with a poll at the very beginning, trying to understand whether companies fit into a different category of, let's say you're a SaaS company, let's say you're a device company, let's say you're a B2C play, or maybe you're even a service provider. We will then, during that workshop, move people into breakout rooms where we'll spend some time talking specifically about companies that are the same as you. In other words, you'll get an opportunity to spend time talking about SaaS if that's what you really are. So we'll do that. When we get into the session on the 28th, a couple of other things you'll see here, we have that one. We also have the pitch decks for raising capital from different sources by Garibaldi Capital on the 30th. And I'd like to thank everybody for joining us. I think that's all we really wanted to say today. And we'll catch up with everybody a week from today. Thank you very much.
Thanks so much for joining us, everybody. Great to be here. See you next week.
Thanks, then. Bye.